In the financial world, there are no coincidences. There are only strategies that you do not yet see. For the last 50 years, we have been told that the price of silver is discovered in New York. We are told that men in suits, shouting in a pit or clicking buttons on a terminal in Chicago, decide what an ounce of history is worth. They trade paper contracts, they trade promises. And for 50 years, the world accepted their price, but something broke this morning. If you look at your screen, you see silver trading at $84.50 in New York, a historic high, yes. But if you get on a plane, fly 14 hours to Shanghai, and walk into the gold exchange, you cannot buy an ounce of silver for $84. You cannot buy it for $90. You cannot even buy it for $100. The price in Shanghai is $115. That is a $30 gap. In technical terms, we call this an arbitrage spread, but in reality, it is a scream. It is the sound of a market that has snapped in half. It means the paper map no longer matches the physical territory. Right now, as you listen to this, a river of silver is flowing out of London and New York. It is moving at a speed we have never seen before. It is being sucked into a vacuum in the East, and the window to act on this information is closing, because on January 1st, the rules changed. And the West hasn't realized it yet. This is the story of the arbitrage window. To understand the heist, you have to understand the mechanism. It's called arbitrage. It is the force of gravity in finance. If gold is cheaper in London than in New York, traders buy in London and sell in New York until the prices match. It is the law of physics. The gap must close. Normally, this gap closes in seconds. Algorithms do it. But this gap, this $30 chasm between East and West, has been open for weeks and it is getting wider. Why? Why hasn't the free market fixed it? Because you cannot ship paper to China. The Shanghai Gold Exchange does not accept futures contracts from the COMEX. They do not accept unallocated accounts from the LBMA. They demand the brick. The bar, the physical metal, traders are trying to close the gap. They are frantically draining the vaults of London. But here is the problem. Physical metal is heavy. It is slow. It takes time to refine. It takes time to ship. The velocity of physical silver cannot keep up with the velocity of the paper price. The West is bleeding out faster than it can clot. We are watching a run on the bank, but the bank is an entire hemisphere of the planet. Why does this price difference exist? Why is silver worth more in China? Because these are two fundamentally different worlds. New York is a casino. Shanghai is a factory. In New York, silver is a financial instrument. It is a line on a graph. It is something you trade to hedge against the dollar or to speculate on interest rates. For every ounce of real silver in the COMEX vaults, there are estimated to be 300 to 400 ounces of paper silver traded. It is a game of musical chairs where there is one chair and for 100 people. In China, silver is not a trade. It is an ingredient. You cannot build a solar panel with a futures contract. You cannot build an EV battery with an ETF. China controls 80% of the world's solar manufacturing. They produce the majority of the world's electronics. For them, silver is as essential as electricity itself. The factories in the East are starving. They are consuming silver faster than the mines can pull it out of the ground. They are bidding up the price because they have to. If they don't get the metal, the assembly lines stop, the factory lights go out. And the Chinese Communist Party does not like it when the lights go out. So the Shanghai price is the survival price, the New York price is the fantasy price, and right now, the fantasy is being dismantled by the reality. But there is a twist, a specific event that turned this spread into a crisis. Did you hear about the new export controls Beijing implemented 2 weeks ago? No, you didn't, because the financial news was too busy talking about interest rates and stock buybacks. On January 1st, China quietly reclassified silver. It is no longer just an industrial commodity. It is now a strategic resource in the same category as rare earth elements. This brings it under strict export licensing control. This created a Roach Motel for silver. Metal can enter China, but it cannot leave. The arbitrage is a one-way street. The silver leaving London isn't just going to China to be sold, it is going there to die. It is being removed from the global circulating supply forever. This is why the price in Shanghai exploded to $115. The domestic market inside China knows that the government is hoarding. They know the borders are closed to exports. They are front-running their own government. They are panic buying every ounce they can find because they know it is the strategic asset of the next decade. Pause for a moment. The information you are hearing right now, the export bans, the inventory numbers, the Roach Motel mechanics, this is not on the evening news. They will tell you about this after the price hits $200. I am building a dossier on the next phase of this reset. If you want to see the data before the rest of the market wakes up, make sure you are subscribed. Join the few who are watching the river, not the screen. Now, let's look at the technology that is making this shortage permanent. You might ask, why now? Why is the demand so desperate? It's not just solar panels anymore, it's AI. The new generation of AI chips, the hardware running the neural networks that are changing the world, requires massive amounts of power. And power requires conductivity. Silver is the most conductive metal in the universe. You physically cannot move electrons faster than you can through silver. As we push the limits of physics with AI, copper is no longer good enough. It has too much resistance. It gets too hot. The next generation of interconnects, the next generation of high-speed bus bars ... They are all silver. Longi Green Energy, the solar giant, issued a silent warning last week. They are attempting to thrift silver out of their panels. They are trying to use copper plating. Why would a company risk the quality of their product by using an inferior metal? Because they can't find the silver. At $85, their margins are thin. At $115, they are non-existent. They are panic engineering because the supply chain has snapped. So the East is draining the West. The price is exploding. What does the Western financial establishment do? Do they admit they were wrong? Do they let the price rise? No, they fight dirty. Last week, the CME Group raised margin requirements on silver futures by 47% overnight. This is the kill switch. It forces traders to put up nearly double the cash to hold their positions. In 2011, when they did this, the price of silver collapsed by $6 in 10 minutes. It is a weapon designed to force liquidation. But look at the chart. This time ... the gun jammed. The price dipped for maybe 15 minutes and then bought right back up. The kill switch failed. Why? Because you cannot margin call a physical shortage. The people buying silver right now aren't leveraged speculators on Robinhood. They are sovereign wealth funds. They are central banks. They are industrial giants. They don't buy on margin. They buy with cash and they want the metal. The banks are trapped. They are short millions of ounces of paper silver that they sold to suppress the price. Now, the holders of that paper are standing at the delivery window asking for bars that are currently sitting on a ship in the South China Sea. We have seen this movie before. In 1968, the London Gold Pool tried to hold the price of gold at $35 an ounce. They sold thousands of tons of gold from their vaults to suppress the price. They thought they could fight the market, but the market always wins. The demand was too high, the vaults ran dry. And over a single weekend, the gold pool collapsed. The price skyrocketed, the market closed for 2 weeks. When it opened, the world was different. We are in the 1968 moment for silver. The London silver pool is collapsing. The arbitrage window is the crack in the dam. The $30 spread between NY and Shanghai is the water leaking through. And when this dam breaks, there will be no $85 silver. There will be no $115 silver. There will be no offer. No offer means you call your dealer, and he says, I have no metal to sell you at any price. It means the price discovery mechanism shifts from what will you pay to what have you got. So, what do? The window is closing. The ships are sailing, the East is locking the gates. The illusion of $85 silver is a gift. It is a time machine that allows you to buy an asset at a discount to its reality. But you must understand, you are not buying to make money, you are buying to save money. You are trading a currency that is dying for an asset that is being reborn as a strategic imperative. Do not look at the paper price. Look at the spread, look at the flow, look at the river. When the Shanghai price becomes the world price, the arbitrage will be over, and the opportunity will be gone. I am tracking the next move of the central banks. If you want the blueprint before the public panic begins, the link is below. The West is empty, the East is hungry, and you have a front row seat to the end of the paper empire. I am the auditor. Welcome to the real world.